Can dividend funds protect investors from stock market volatility? There are now more than 100 exchange-traded funds focused on dividend stocks, with around $500 billion invested in them. The majority of assets are concentrated in the biggest index funds, like Vanguard's Dividend Appreciation ETF, or VIG. It's probably well known in the past for having a focus on financials and tech stocks, but not all dividend funds have the same strategy. To find out more about these funds, I'm joined by Aniket Ullal. He's head of ETF research and analytics at CFRA Research. Aniket, is it fair to say these dividend funds are now a type of safe haven investment?
The short answer is yes, but I think the important information is in the details. In other words, I think that the way the ETFs are constructed and the way the underlying indices are constructed really matters. So if we take, for example, VIG, which you just mentioned, it has a lower yield because it focuses much more on stocks that pay regular dividend as opposed to focusing just on high yield dividend stocks. Whereas if you look at something like SCHD, it has a higher yield primarily because it has fewer stocks and can concentrate in those stocks that pay higher dividends. Now, because of these different methodologies, SCHD has a very different sector exposure than VIG. And as a result, because of that sector exposure, the performance has been very different from VIG. So yes, dividend ETFs can be a cushion in times of volatility, but the type of ETF and the underlying index does really matter.
Now, you talk there about sector exposure. What trends are you seeing in dividend ETFs at the moment?
What's interesting is that we had big rebalancings or reconstitutions of these underlying indices in March, and we saw some big changes in some of the underlying ETFs. So, for example, SCHD had a big change where the exposure to energy went up by 8% and the exposure to financials went down by 8%. And we know that this year energy has been an underperforming sector both in the last month as well as throughout this calendar year. As a result, SCHD is down 5%, which is more than the broad market, as opposed to VIG, which is much heavier, as you mentioned, in financials and tech, and has therefore outperformed SCHD. So the sector exposure really does matter. SCHD is much more energy focused, lower weight in financials, lower weight in tech. VIG has a much higher focus on technology, about 23% in tech. So these differences matter, and the performance of each sector then influences ultimately the overall performance of each ETF.
But tech still can't be totally avoided, can they, with these dividend funds?
Ultimately, the starting universe is the broad market. And we know that in the broad market, tech is certainly the biggest sector. So tech can't entirely be avoided, but there are significant differences. VIG is 23%, in SCHD tech is less than 10%. And ultimately, those differences can add up when you look at the overall returns of the ETF. So tech can't be avoided. And certainly, we know that some tech stocks have become more mature. They pay dividends. Apple is a good example. And so we know that tech can't be avoided, but the weights of tech in each ETF does matter.
And how would you advise people to look at these type of dividend funds? Is it all about the yield, or is it about performance as well?
It's really both, because ultimately, as we saw with the SCHD, if you have a very high weight in a sector that's underperforming, that capital appreciation, in other words, the downturn in that particular sector may offset the benefits you get from high yield stocks. So the sector exposure does matter. What we encourage investors to do is look at multiple factors. One factor is what are the factors used to select the stocks in each ETF? What do the sector exposures look like? And finally, how concentrated are the stocks in the ETF? Because again, as I mentioned earlier, sometimes if you have fewer stocks, even if the emphasis is not on high dividend yield, when the holdings are smaller, you can actually concentrate in certain number of stocks which have a high yield, and you can actually end up with a higher yield overall than other ETFs. So investors have to really weigh all of these different factors when choosing a dividend ETF.
Now, I noticed that most of the biggest funds in this space have a passive strategy. Is this wise in the current environment?
I think that's a great point, Ramzan. What's interesting is if you look at the top 10 US-focused dividend ETFs in the US, 9 of them are indexed. And I don't think this is intentional. I think it's just a legacy of how the ETF industry has evolved. And really, this opens the door for ETF issuers to come in with newer ideas, particularly as we see issues like tariffs and so on coming in, which really affect ETFs in very unpredictable ways. We think there will be more demand and more opportunities for active management in the dividend space. And certainly the fact that there's so much indexed assets opens the door for new types of players and ideas.
That was Aniket Ullal from CFRA Research. And that was your look at dividend ETFs. I'm Ramzan Karmali, and this is Reuters.